If you work for yourself, you're essentially playing a game with rules written for somebody else. Welcome to this explainer. Today, we're uncovering perfectly legal, kinda hidden tax strategies that can literally save freelancers, consultants, and contractors thousands of dollars before that next filing. Let's go ahead and level the playing field, shall we?
$11,200. Yep, that's exactly how much the average American freelancer overpays the IRS every single year. And the crazy part, they aren't losing this cash because they're cheating or making some huge malicious error. Nope, they're losing it simply because they're stuck using the standard W-2 rules they grew up with, instead of actually leveraging the code designed exclusively for business owners.
So here's the core problem. The US tax code is this massive, dizzying beast of a document. We're talking 73,954 pages. Honestly, nobody reads the whole thing, probably not even the IRS. But the folks who know just a few specific pages, they pay a fraction of what everyone else does. In this explainer, we're going to zero in on 3 specific rules buried inside that massive code that you almost certainly won't hear about during a standard, run-of-the-mill tax appointment.
All right, let's dive into rule number 1, the home office trap, and why taking the easy way is actually costing you money.
When you calculate your home office deduction, and assuming you use the space exclusively for business, right, not just for Netflix binges on the couch, the IRS gives you a choice. There's the simplified method, which most people use because it's super easy, $5 a square foot, capped at 300 square feet. That maxes out at a $1,500 deduction. But then there's the regular method. This one requires tracking actual expenses, things like mortgage interest, utilities, and repairs. Yes, it is more work up front, but it consistently yields 2 to 5 times more in deductions.
Let's put some real math to this. Imagine you've got a $2,400 monthly rent in a 1,000 square foot apartment with a dedicated 150 square foot office. Under the regular method, that translates to over $4,300 in deductions every year. That beats the easy way by a massive $2,800 annually. You know, that's not just a rounding error. That is literally money for a sweet vacation going straight back into your pocket, simply because you kept a few extra receipts.
Moving right along to rule number 2, defeating the second tax and escaping that nasty 15.3% penalty.
Now, this is the mistake that costs freelancers the absolute most. In fact, applying the fix we're about to show you saved one viewer 14 grand in a single filing last April. But to understand the fix, you really got to understand the penalty. See, at a regular corporate job, your employer pays half your Social Security and Medicare taxes. You never even see it happen. But when you're self-employed, bam, you're hit with a brutal 15.3% self-employment tax right off the top to cover both halves yourself, and that's before standard income taxes even began. For a freelancer pulling in 80 grand, that is over $12,000 gone instantly. Ouch. So the crucial workaround here is how we restructure to avoid taking that hit on literally everything we earn. If you're set up as a sole proprietor, every single dollar of profit is subject to that 15.3% tax. But by electing S-Corporation status, which, by the way, usually makes financial sense once you hit about $40,000 to $50,000 in profit, you get to split your income. You divide it into a taxed salary bucket and an untaxed distribution bucket. So that heavy 15.3% tax, it's now only applied to your salary portion. To show you just how powerful this is, let's say your business earns $100,000. You decide to pay yourself a reasonable salary of 60 grand, and you take the remaining 40 grand as a distribution. Because that $40,000 distribution is completely shielded from the self-employment tax, you instantly save over $6,100 every single year. You're just using the system exactly as it was designed, protecting your hard-earned money.
All right, on to rule number 3, the ultimate loophole, maximizing this solo 401k.
Okay, this is absolutely the most powerful tool in the freelancer tax code. $70,000. Yes, you read that right. A self-employed person can legally contribute up to $70,000 into a solo 401k for the 2026 tax year. I know, it sounds impossibly high, no way, right? But there is a very specific, logical reason why the code actually allows for this.
Here's the deal. When you're self-employed, you wear 2 hats. You are the employee, and you are the employer. Because of that, you get to fill both of these contribution slices. You can put in up to $23,500 as the employee, and your business can pitch in up to 25% of your compensation as the employer. Together, they combine to reach that massive ceiling. And remember, every single dollar you pack into this account is completely shielded from taxes this year. The real-world impact of this is truly staggering. For a freelancer sitting in the 22% tax bracket, completely maxing out this solo 401k account drops their current year tax bill by an incredible $15,400. In one single, totally legal move, you are locking down your own retirement while wiping out a huge chunk of your tax liability. I mean, Congress literally voted for this. It's the system working perfectly for you.
So, to make this a reality, you need a precise action plan. Step 1, open the account with a brokerage. Honestly, plenty of them offer these with 0 fees. Step 2, calculate your limit based on your net income, using the IRS worksheet. But hey, look really closely at Step 3, because this is where people trip up. You have until tax day, usually April 15th, to actually fund the account. But the absolutely critical part? The account must be opened before December 31st of the tax year. If you wait until January to open it, you are officially too late for the previous year. So get on it early.
Now for the fun part, the payoff, stacking your tax savings.
I want to show you how all 3 of these rules stack together on a real-world income. Because honestly, the math gets almost unbelievable. Let's take a freelance graphic designer making 95 grand a year. By methodically applying the S-Corp election, they save over $5,500. Then, choosing the regular method for their home office deduction instead of the easy way saves them another $1,056. And finally, by making strong contributions to a solo 401k, they save over $7,400. Stacked all together, our freelancer effectively pockets an extra $13,989. That is real money staying in their life, instead of going straight to the IRS.
Looking at this chart, the complete transformation is absolutely crystal clear. Without these strategies, this freelancer is staring down a pretty painful $24,600 tax bill. But with these 3 rules applied, it plunges to just $10,611. It proves exactly how lucrative it is to stop acting like a regular W-2 employee and start playing the game with the rules designed explicitly for business owners.
Ultimately, the system is designed to reward the people who take the time to understand it. You've just learned 3 incredibly powerful tools sitting right there inside the code, which leaves us with one vital thought to wrap up on. If these 3 massive strategies were just sitting there in plain sight, waiting for you to use them, what else might your accountant be missing? Thanks for hanging out with me for this explainer, and hey, here's to keeping a whole lot more of what you earn.